Keeping up with tax changes, well, it can feel nonstop, can it?
Yeah,
But it's really vital.
it absolutely is.
Today, we're doing a deep dive into something specific and pretty important in Kenya right now.
Yep.
That's part 3 of the Gazetted Kenya Finance Bill 2025.
Focusing right in on value-added tax, or VAT.
Exactly. We're going to unpack the proposals there.
And this bill, just for context, it hit the National Assembly and was published in Nairobi, May 6th, 2025.
Right.
It proposes several tweaks to the current VAT Act, Cap 476.
So our mission today,
Is really to get under the skin of these amendments, not just list them out.
but figure out what they might actually mean. For businesses, for individuals, for you listening.
Precisely. Clarity is key here.
Okay, let's get into it. Starting with definitions. Section 2 of the VAT Act. What's changing?
So the main thing here is a new definition for tax invoice.
Okay.
The bill proposes adding that this term, tax invoice, it specifically includes an electronic tax invoice.
The digital side.
Yes, as long as it's issued following the rules in Section 23A of the Tax Procedures Act.
So practically speaking, this just means digital records are officially okay now.
Pretty much. It's formalizing it, bringing the VAT system, properly into line with modern digital practices.
Makes sense. Everything's going digital.
It is.
All right, moving on. Section 8. This is about taxable supplies. Looks like a few interesting bits here.
Yes. Section 8, subsection 2, there's a small change, first adding the word "and" after unregistered person.
Just tidying up the language.
Seems like it, yeah. Legal precision. But more substantially, paragraph C in that subsection is proposed for deletion.
Paragraph C. Now, we don't have the exact old text in front of us, but
Yeah.
any thoughts on what that might have covered, generally?
Well, often these kinds of paragraphs, they set out specific conditions or maybe exclusions, perhaps related to certain transactions involving unregistered people, or maybe a threshold.
Yeah.
Removing it could mean simplifying the rules or perhaps changing how those specific interactions are treated for VAT. You'd really need the original text for the full picture, though.
Understood. Okay, still in Section 8, there's another change in subsection 3B. About broadcasting.
Ah, yes, this one's quite relevant today.
Looks like it.
They're proposing to replace broadcast television
Okay.
with a much wider term: internet, radio, or television broadcasting services.
Wow, okay. That's broad. So definitely not just old school TV anymore.
Not at all. This really seems aimed at capturing, well, all sorts of digital and online broadcasting.
Like streaming services,
Oh.
online radio.
Exactly. Video streaming, audio streaming, maybe even podcasters or content creators who monetize through those channels online. It looks like an effort to sort of level the playing field tax-wise, reflecting how media works now.
That's a big shift. Could affect quite a few players and maybe even consumers down the line.
It certainly could.
Okay, let's pivot to Section 17. This is about input tax credit. Always crucial for businesses. Several changes proposed here, too.
That's right. Section 17, subsection 5, dealing with the conditions for claiming input tax. Again, like in Section 8, paragraph C is up for deletion.
Okay, same caveat without the original text. Hard to know the exact impact, but likely removed a specific condition.
Correct. And then paragraph D is being changed quite significantly. It's being replaced.
Replaced with what? What's the new rule?
The new paragraph D sets a time limit. A registered person looking for a refund of excess input tax.
Yeah.
They have to lodge that claim within 12 months
12 months. From when?
from the date the tax became due and payable.
Okay, so a clear deadline now. Previously, was it open-ended or just different?
The text doesn't specify the before, but introducing a firm 12-month window is a key change.
What are the implications? Good or bad for businesses?
Well, it brings certainty, which is good, a defined period. But businesses absolutely need their systems sharp. They need to track input tax accurately and file within that year, or they could lose out.
Right, no room for delays.
And interestingly, paragraph E of that same subsection is also proposed for deletion. So more streamlining or adjustments to that whole input tax claim process.
That 12-month deadline really underlines the need for good bookkeeping, doesn't it?
Definitely. Efficiency becomes even more critical.
Okay, let's look at Section 31. Remission, refund, set off of VAT. It's quite a list of deletions here.
Yes, Section 31(1), which outlines the commissioner's powers on these things, it's being amended by deleting quite a few specific paragraphs. Let's see, 62, 63, 89, 91, 109, 112, 113, 128, and 129.
Wow, that's a chunk.
Yeah.
What kind of things are usually covered in paragraphs like these? Specific exemptions?
Often, yes. They might detail specific industries, situations, or types of transactions that qualify for VA exemptions, or maybe special conditions for getting a remission or a refund.
So deleting them suggests?
It could suggest a move towards a more standardized system, fewer specific loopholes or special cases, perhaps.
Making it simpler, maybe, but potentially removing benefits for some.
That's the likely trade-off, yes. But there's a transition period mentioned.
Oh.
Any exemptions that were granted under these paragraphs before the deletion happens, they'll remain valid until June 30th, 2026.
Okay, so a bit of breathing room for those affected, that's important.
It is. It softens the immediate blow.
You also noted something specific about paragraph 89, even though it's being deleted overall.
Yes, sort of a detail within the deletion.
Right.
In paragraph 89, the phrase other aircraft spare is substituted with just aircraft. While the whole paragraph is going, this change within it before deletion might signal a change in thinking about how VAT applies to aircraft more generally, not just spares. But again, context is needed.
Interesting nuance. We also saw quick mentions of amendments to Section 42A and 47 of the Tax Procedures Act. What areas do those cover?
Right. Section 42A of the Tax Procedures Act, that usually deals with appointing VA withholding agents.
Okay, the ones who deduct VAT at source.
Exactly. So changes there might affect who can be an agent or maybe their responsibilities. And Section 47, that's generally about the process for handling overpaid tax, getting refunds or offsets.
So procedural changes likely in those areas.
Probably affecting timelines, conditions, how you actually go about claiming back overpaid VAT.
Got it. Finally, let's touch on the first schedule of the VAT. This list supplies exempt from VAT. Looks like more deletions here.
Yes, quite a few in Part 1, which covers exempt goods. The proposal is to delete paragraphs 21, 29, 30, 31, 32, 33, 34, and 35.
That sounds like it could hit consumers directly, potentially raising prices if things are no longer exempt.
It certainly could.
What kind of goods typically end up on these VAT exempt lists?
Usually essentials, things like certain basic foodstuffs, some agricultural produce, maybe specific medical supplies, educational materials, things considered necessities.
So taking items off that list
Means they potentially become subject to VAT, which usually means a higher price for the end consumer unless businesses absorb it, which is less likely.
So fewer VAT-free goods, potentially.
That's what the deletion of these paragraphs strongly suggests, yes, a narrowing of exemptions.
Okay, wow. So quite a range of proposed changes for VAT in Kenya, then. It really seems Part 3 of this finance bill is packed with significant points.
Absolutely. From the basics like definitions and electronic invoicing through to what's taxable, especially in broadcasting.
The rules for claiming back input tax getting tighter with that deadline.
And then the reduction in specific remissions or exemptions and potentially fewer VAT-exempt goods. It's comprehensive.
Businesses and individuals really need to get familiar with these proposals.
Understanding the potential impact is crucial, yes, for compliance, for budgeting, for planning.
And if you want to see all the details for yourself, we highly recommend it. For a comprehensive understanding of all the proposed tax changes, you can download a copy of the Gazetted Kenya Finance Bill 2025. We've put the link in the description for this deep dive.
Good idea. So just to quickly recap the key VAT areas we discussed.
Please.
We saw the move to formally recognize electronic tax invoices. Changes to taxable supplies, notably broadening the scope for broadcasting services to include internet and radio.
The new 12-month deadline for claiming input tax refunds.
Exactly. Plus, the deletion of numerous specific paragraphs related to VAT remissions and exemptions, though with that transition period until mid-2026 for existing ones.
And finally, the potential shrinking of the list of VAT-exempt goods.
We also briefly noted potential changes to VAT withholding agents and the overpaid tax refund process under the Tax Procedures Act.
It's definitely a lot to digest. Understanding these potential shifts is, as we said, vital for everyone in Kenya.
It really is.
So, as you think about all this, maybe consider this. How might these proposed VA changes, if enacted, actually affect you? Your household budget, perhaps? Or your business operations next year?
That's the key question. And exploring the full finance bill beyond just the VAT section we focused on today is definitely worthwhile for the complete picture.